Welcome, everyone. Welcome to the Hurley Investments Market View Commentary for the middle of the month, March 13th. My name is Kevin Hurley, and I have a ton of stuff to go over with you. Now, a bunch of you are here today, so let me first go over. We collar trade, and I guess I want to hear reasons why. Why do we collar trade? And it's going to be rather important, but we'll see if you guys understand why. Why do we collar trade? Love it. Awesome one. Protection. Well, not really protection up, but protection for the downside. Yes, agree 100%. Stuart, great point. I love that one. To make up money, not all money, but some money. On the way down. What are some other things that I've told you guys and why we collar trade? What can Hurley Investments do that no one else is doing for you out there in regards to the collar trade? And now they're thinking. William, you're here. And Jim Bosserman, I'm so glad you're here. So Jim and Bosserman and Kohler, you got to tell Rich to listen to this one. And this one's going to be a while. This is going to be a pretty good one for tonight. Russ, you already said. David, there you go. William, I thought you would say this, but let's give it to David W. We dollar cost average without having to ask for more money. And if I'm going to go ahead and I'm going to make that claim, I am going to do a couple things to this so that it's understood. And it's our most important. I wanted to do an example of that for this particular class. What I wanted to show you before we went through all the crap over the weekend, I want to give an example of that. So if we buy 1,000 shares that we buy to open and add a $7 long put, which is 7% on 1,000 shares that are worth buy to open, I'm going to say at $100 a share, right? Our cost basis is going to equal $107,000, right? Let's say it was a regional bank and we go through earnings. How much would that regional bank lose going through earnings? You guys just pick a number for me, something that you think is reasonable. And actually, when you call or trade, I probably would also add a short call, especially for the first one, right? And add a short call, and I'd probably do it in that $3 a credit. So the first time going through, in all reality, you're closer to 104,000. That is more realistic. Okay, so we go through earnings. First quarter earnings, right? And Russ is like, oh, they're going to lose 50%. So we're going to say earnings awful, and they lose 50%, which means every share we had at 100 is now worth 50 bucks. If you had a stock jockey, that's a stock picker that thinks they got it all figured out, right? If you had a stock jockey, your $100,000 you invested in the stock would be worth 50 grand. They give you a call. Hey, this is supposed to go to 200. It lost half its value. Could you go find 50 grand, right? If you were to dollar cost this stock, so let's put it, if you were every other broker, you would invest another 50K to be down 50K, but have a cost basis of $75 per share, right? Is there anyone here that does not understand that or that would disagree with me? Anybody here that's like, Kevin, I call BS. Bullshit, right? You guys are all good? William? You good, William? Okay. But by caller trading, how much did you lose? And you're like, dude, give me some understanding. We'll put some more prices in there for you, right? Well, we still have the right to sell our stock at 100. So how much did we lose? The premium, or the majority of the premium, which is that $4,000 of our initial investment, right? So here's the question. Would you rather have lost 50 or 4? Would you rather lose 50K or 4K? Because this is going to decide if I still want to do business with you. You've got to get this one right. William, I'm going to keep that to myself, but William chose correctly, 4K, right? How come no one else typed anything in? Did I scare you guys that much? Okay, so here we go. Hurley Investments takes the profits from the puts and buys 1,000 more shares, equaling 2,000 shares. The 2,000 shares cost basis. You just take 107, you divide it by 2, and it's going to equal $53.50. $53.50 is your cost basis. If these shares gain 10%, you're profitable. If they gain 10%, when you dollar cost average them the old school way, the every other way a broker does it, you're still down 45 grand. Okay, here we go. Next earnings. And I'm going to put this little thing, and things still suck. And when I say things, I'm going to call it the market. I'm going to call it inflation. I'm going to call it the administration. I'm going to call it everything. And things still suck. What happens on this earnings? Russ, I'm going to give you one more shot. What happens on this earnings? Russ is going to be like, "Meh, what do we do? No, things still suck. So don't tell me 10% up." But it could be. But I want things still suck. I don't want things are better. 25% down. Okay. Things still suck. And they take a 25% loss. We have 2,000 shares. It still will cost somewhere between maybe 5 to 7%. I'm going to use 6%, right? So if we have a $50 stock times 6%, it's still going to cost $3 per put. We have 104. We're now up to 3 times 2. We're now up to a 110K investment that now loses 25%. I got to do the math on I can't give you guys poor math, right? Doing the math, $50 times 0.75. So $50. So stock price is $37.50 per share. Rich, love it. So Kohler and Bosherman, you don't have to talk to Rich anymore. Okay, so we're just going to do our math, right? Our 2,000 shares, we can sell at 50, right? Which when you do the math, it's 100K. Still, we divide the 100K, divide by 37.50. 100,000 divided by 37.50. We now have, or will equal, 3,750 shares. And I'm going to be the first one to tell you, we're not going to keep that because we want to pay for some of our long puts. We're probably going to be at 3,500 shares, where the other 250 shares or what we would have spent, I take back for paying for the protection. Next earnings. So I should kind of put it like this too, right? So it all looks the same. Next earnings, I'm going to say as flat as a pancake. This is where it turns around, right? This is where they say, hey, we're making changes. We're doing this, we're doing that. Next quarter, we're going to be profitable. But this earnings, they're flat as a pancake. And we have 3,500 shares that lose now at 37.50. Last time it was $3. I'm just going to use some round numbers here. So I'm going to do 3,700, right? Nope, 3,500. times the $2 we spent for protection, which is around that 6%, right? So we're down another, we lose $6,000, right? Lose more than that, we lose $7,000. Let's do our comparison right now. If you just invested in the stock, right? Just call it the buy and hold. Can't type. The buy and hold. At $37.50 a share, you have $37,500 and have, geez, Hurley, and you've lost $500 for a 62.5% loss. Or Hurley Investments, you invested 104, another 4 there, 108, 115, right? 115K total investment, which today equals, well, we didn't lose 2 there. Let me do the math again. Let me do the math one more time. 104 to start. We took some money back on that second one, so it's only 104. We lost 7 on this last one. It's 111. $111 investment now equals 350 times $37.50 equals 3,500 times $37.50. Is that possible? 3,500 times $37.50. Wow, my numbers aren't adding up, but that makes good sense because nothing's gone up yet. So let me find out where my calculations are wrong. Sir, we paid for the turn shares, it would take it because it lost 25%. I turned it flat as pancakes, so we lose our $7 total. $2,000 shares times, it lost 25% though. We still get to sell them for 100K. 100 divided by 3750. Yep, I did my numbers wrong. This makes sense. It was 266 shares. If I don't do my numbers right, it won't work out. Which means, again, I would probably sell off 266. Sell 100K, which means we would have 2,400 shares. So we got to do our math right. Vested, there's lawsuits times 2,400 shares, and 2,400 times 37.5 is 90K. So we're 9 months into Hurley Investments, and the comparison is $35,000 at a 62% loss, or would you like to be at $90,000 with a 10% loss? Where would you rather be? But this is the final one. So we're in this now a year, right? But we get a good quarter. Russ, take it away. We get a good quarter. How much does the stock go up this quarter? Because while Russ is telling us we have 2,400 shares, the 37.50, it's still going to be right around that $2 range for put protection, which is you're now digging into your account, spending an extra $4,400, right? But the stock pops 30% per Russ Kramer. Not Kramer dude on CNBC, Jim Kramer, but we're going by Russ Kramer, our guy that's not full of crap, right? We're still going to lose that $2. $2,400 times 37.50 that goes up 30%, so that's 1.30 that you got to times it by, right? Let's find out what that's going to mean. It's going to be 2,400 shares times 37.50 times itself plus a 30% gain means that the stock price is now $48.75, which means the total investment, which if we keep adding 111 plus another 48, I'm just going to let you know it's at about 116K right now, is equal to 48.75 times $2,400 is equal to 117K. We are profitable by 2%, while everyone else is still, in fact, I should just write this down. We are profitable by 2%, while everyone else is down 52.25%, or $52,250. And now I'm going to call this the last earnings. And this is the one that matters because we're now in it a year and 3 months, right? Russ Kramer, last earnings, knocked it out of the park. Righted the ship. Things are going good. Last earnings, knocked it out of the park. How did they do? And of course, knocked out of the park when you're still down 50% on your shares of stock. It's like, Russ, how much did they do? Another 30%. 30% gain. This is where it's just amazing. 2,400 shares times that other 30% gain. So we got to take what, $48.75 times itself and another 30% gain. $48.75 times itself 1.3. Wow, it's now worth $63.37.5. I'm going to put the half cents in there. Times the 2,400 shares, it's equal to 152,100. Everyone else, 63,375 for a 36.725% loss. For us, we're up 20%. The neat thing is, 2 years later, it trades at, and I'm just going to make this up. I'm not going to put Russ on the spot. It trades at $100 again. Total time, 3.5 years. And I'm going to assume it's gone up and down. I'm just going to give us something generous, that in the next 2 years, 2 down, 1 sideways, 1 up. That's usually the cycle. 2 down earnings, 1 sideways, 1 up. If we did it again, I'm going to be generous. I'm not going to say we double, but we might have 4,000 shares times 100 is going to equal 400K in this position. While everyone else breaks even. This is the power of the collar trade. I'm giving you a 3.5-year timeline. In 2020, we had that pop. And boy, if you were in 1918 or 2020, amazing year. 2021, 22, not so good. 2023 might be the same. We might not even get our back end of the year. It might be 2024 before we get things moving. But this 300% possible return is what you guys have looking for you at the other end of the spectrum. This is why we collar trade. Russ, if the stock loses 50%, can the put be profitable enough to buy another 100 shares or 1,000 shares, excuse me, without profit margin? Without margin? Of course it is. We're not going into margin. This is just profits from the puts. And when it hit that 266, 0.6 shares, that's what you'll notice. I don't round it out because I'd rather have my protection paid for. I'd rather only take 240 shares, maybe take that 7-8-9% and pay for that protection so that we still have capital and cash available in the accounts. None of this is being done on margin. But this is the collar trade and maybe a realistic time frame that we're dealing with. Let me go through what's happened the last couple days. This is a real live scenario of someone that I know with $100 million on SVB. In all essence, we found out Tuesday of last week, VC, venture capitalists. So let's do Tuesday of last week, VCs, venture capitalists, started telling their clientele to pull their money out of SVB, Silicon Valley Bank. Anyone know what the minimum amount the bank is going to have in place? And let's say it's all done electronically. I know real banks don't have that much, but give me an idea. How much do you think SVB has for a potential run on the bank? Anyone know? $20. I know, a month ago, Jim Cramer advised to invest in SVB because he didn't do his homework. While that SOB makes millions of dollars on TV, acting like he does his homework. It was more like 2.5 months ago. Jim Cramer, invest your money in SVB. Probably sold short afterwards. I agree 100%. I don't know for sure either, but I'm going to say maybe 10% held in cash. It's probably closer to 7% for a run on the bank. Here's what I'm going to say. Oh no, there is a 40% run on our deposited funds. So here's what happened first of all. On a bank, you take people's money in. You can't hold on to it in cash because you got to loan it out. But you know what? Our banking system allows for money laundering. A bank will take that money in from someone, so that dollar is owed to that individual that deposits money in the bank. So that $1 already has a $1 to $1 obligation to the customer, right? Let's go ahead and put that in there. Has a dollar to dollar obligation from the bank. So if you deposit $1 in there, you get some interest, but they owe you that $1 back. So can someone tell me, what the hell does the bank do? Especially if you're Silicon Valley Bank. What's the first thing that they do with that $1? Ooh, Mon says they take that money and lend it to someone else. They actually do something before that. They do something before they lend it out. Before they invest in a tech startup, they do something else. Before they invest in a startup company, before they invest on a new project, but they buy bonds. Bingo. The bank first takes every dollar and buys U.S. government securities. Someone tell me why. I can come up with 3 reasons. Why do they do that? Ooh, love it. I'm going to type it just that way. To get interest and juice the returns. Bingo. Love it. Because you can take that money, put it in a U.S. government security, get paid, well, actually buy it at a discount by a quarter point on the Fed window. Plus, if you buy like $10 million of it, you get another quarter point. Plus, if you buy like $100 million, you get another quarter point. But you buy it where you're going to make 5% interest. And you're going to buy it, instead of at $1,000, you're going to buy it at like $925. Because the government needs you to buy it so they have money to pay off their debt. So the banks do it. They get this killer deal. They're actually hoping to make 5.75% when it's done, at least that first year. They're going to give you interest of 3.25%. They're going to come up, 2.25% better. But what's the other reason? And longer term for a slightly higher rate. Remember, we have an inverted yield curve right now, where our short term is a lot higher than the long term. But what's the second reason? I'm going to say most important. Russ, can you see why that inverted yield curve makes those longer term ones just bad news? That everyone should have known this the first 3/4 basis point we had, 2022 in March. What's the most important second reason? Oh, come on, guys. Big prods for executive bonuses. Hey, before we go bankrupt, we're going to pay off our bonuses if we're SVB. Correct. William, I talked about this with you today. What is it? What did I tell you, William? Or anybody else? Anyone else know? There you go. The banks can borrow against the U.S. Treasury bill, note, or bond, dollar for dollar of what it's worth. So they get a loan out against it. The problem is, if they weren't smart a year and a half ago, when you have an inverted yield curve, that's your first sign. Bring all your way out in time bonds into these bonds that are paying a higher interest rate in a shorter period of time. You've got 5, 7, 9, 10, 15, 20, 30-year bonds that are paying 0.25% interest. Where those same 7, 9, 10, 15, 20, 30-year bonds today are paying 5% interest. Which means you can get 18, 19 times the interest for that same bond dated today than the one that was purchased a year and a half or 2 years ago. Which means the paper value of bonds changes. If you hold long-term or any bonds, any treasuries until expiration, you get back the $1,000 per bond. But during that time period, the paper or tradable value changes. And those bonds that you had 2 years ago are worth roughly $120 today. Nobody wants your bond a year and a half ago that's 7, 9, 10, 15, 20, 30 years out in time, because they can get a bond today that pays 18, 19, 20 times that amount. So when you have a run on a bank is like, we're going to sell our bonds. And they only get 12 cents on the dollar. And they're taking huge losses. They're taking 88% losses on those bonds. Well, we're going to issue another round of stocks for SVB. We're going to create $20 billion to satisfy the run on our bank as we issue through Credit Suisse a second round of stocks. Well, great. Let's do the math. Well, we have 349 billion in liabilities. And our backstop is the word I'm going to use because that's what the word the Fed uses. And our backstop is only worth, because they do have some out in loans and they do have some out in mortgage-backed securities and blah, 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 blah. It's only worth 120. So when they tried to raise $20 billion, they only could get about 10%, 220 million were willing to go. And Credit Suisse was like, well, crap, and 10% of that is ours, right? So there's only $20 million of open interest, in buying more SBV stock. Well, Buffett, you like to do this. You like to buy these bonds, 10 years down the road, you're going to make an 88% return plus 0.25% for the next 7 years. Buffett, you want to bail us out? And Buffett's like, dudes, I don't have $229 billion sitting around. I don't have 100 billion sitting around to buy you out. It's a no-go. So SVB bailed. Poor guy. Did I just lose $100 million? Well, no, because you're going to sell their securities. They're 12 cents to 15 cents a dollar. They've got banks and buildings. You probably will get somewhere between 14 to 17 million dollars. Kevin, I can't run payroll. I can't run our business on that. Yeah, you're probably gonna, if you don't get bailed out, the fact of the matter is you're gonna file bankruptcy. You've got to keep your business open, so you got to fire and sell everything off. Hope you don't get sued. And the next 2 to 3 years, because it takes a process or a period of time, you're going to get back 14 to 17 million through your personal bankruptcy. You're going to lose everything, but they can't take your house or your car. They got to leave you a car, basically. So you're going to get to keep your worst car. You're going to get a nice house, go find a job for 2 or 3 years. You're going to come back with 14 to 17 million. You're still covered for life. Put it in Hurley Investments. Or you go out to your most faithful clientele. You keep doing the business that you've been doing, and your 100 million gets shrunk down to like 10 million. And for 2 to 3 years, you're going to live paycheck to paycheck on credit card, pushing stuff out, and you're going to restart your business. Poor guy was in tears all weekend long. But stupid is as stupid does. Oh, we're bailed out. We're good. What are you going to do? I'm going to take my money out, and there's another Silicon Valley bank that pays great interest because we use some of that interest to pay our workers. And it's like, dude, why not go to like JP Morgan? The safest, the least loan to asset. It doesn't pull all its money out. If you keep putting yourself in that position and you don't have a guy, a COO, a CFO that understands this, dude, hire me for 50 grand and I'll advise you throughout the year on what the hell to do with your money, because the big guys that you're paying the hundreds of $1,000s for don't know shit. And with all due respect, if you're this stupid and you've already lost $100 million once and you're getting a government bailout, I think you're too stupid to work with me. So it's not going to happen. But Kevin, this is the funny one. I heard no taxes. Will pay for this 25 billion bailout. So let's work the numbers one more time, right? For SVB and the New York Bank, it is 600 billion in liabilities. So number one, how much is the bailout? Is 25 billion going to matter? What part of the taxes are backing this? Well, Kevin, the 25 billion is the FDIC, which means to replace just that 25 billion shared amongst banks moving forward, what are the fees going to have to be? In essence, what this really is going to do for individuals buying new properties, we're really hurting middle America for the next 10 years. For the startup companies, we're really killing startup companies for the next 10 years. For borrowing on a commercial level at all, you are really killing it for the next 10 years. And when 25 billion is not enough, for $600 billion in liabilities, we will be taxed next year for what they take away this year. Because it sure as hell ain't coming from SVB, and it's not coming from the New York Bank because they are out of business. Zions Bank is my local. I'm going to tell you, if you are in a credit union, thank goodness for being in a credit union because they don't run the same way. Zions Bank floated between a high of 70 in the last 13 months. I think it's like 57 something, might be the 58.81, might be $67 is the highest. Trading at $29.97. Regional banks are in trouble. Regional credit unions do not seem to be in trouble. So here we go. Why are regional banks in more trouble than credit unions? And go all the way back up to where we started this whole conversation. Why are regional banks in more trouble than credit unions? Do you want me just to tell you? Is all this hurting your head and you guys are like, oh, Kevin, just tell me. Just tell me. So credit unions are using members' funds, members on the credit union. What is the, no. But it's related to members own the credit union, Stuart, but they don't have any say in what they do. In real life, they don't. Credit unions are using members' funds. How much money do member funds have compared to Bank of America? Compared to Morgan Stanley, JP Morgan, Wells Fargo? Little. There we go. Why are regional banks in more trouble than credit unions? Because regional banks don't have the big bucks to get the benefits of buying the U.S. Treasuries. They're just not big enough to go say, boom, I've got 100 million we're putting in U.S. Treasuries. They don't have it. They haven't put themselves in this position, not because they can't. Actually, I want to put that back. Not because they don't want to. They're just not big enough to participate. Pisses me off. I'm not getting these NFL, MLB guys because I'm too small. Hurley Investments is too small. But the regional banks can't participate in these $100 million, hey, buy our debt, and then we're going to count it like this for your percentage that you have to have of assets under management that you can money launder out 2 or 3 times on the same dollar. Don't forget, after they buy the treasuries, right? After they buy those treasuries, they then lend that money out a third time for car loans and home loans and construction loans and payroll loans. That same dollar is attached to 2 or 3 different liabilities for a bank. You don't see that in credit unions. That's why credit unions don't offer great CD rates. They don't offer great savings rates. They're cheaper because they don't do all these other things that these bigger banks do. They can't. They have your money. They don't have a bunch of venture capitalists, a bunch of startup companies, Roku's money, right? They don't have that in these credit unions. Hence, they can't money launder the dollar 2 or 3 times. They have 2 or 3 liabilities on the same dollar. Hence, they can't borrow against a huge amount of government securities. Hence, they're not going to be in the same problem as some of the other banks. Last part of today, then I'm just going to let you guys read all the rest of the stuff I have. Something broke, but the Fed is still expected with rate hikes. How much is the Fed going to raise the interest rate? I just got a comment. Barney Frank joined the Signature Bank in New York when he left Congress that just went bankrupt. Way to go, Barney Frank, who created Frank Dodd that went into law at the end of 2010 that really screwed up my business 2011. Patriot Act didn't help me either. How much is the Fed going to raise interest rates next Wednesday on the 22nd? So it's funny, both of you just said exactly the same thing. They should probably stop, but they will probably do 25. They need to stop, but probably will raise the interest rate up to 25 more basis points. Both of you. .25 to .50. Everything else came in at .25 to .50. Why is stopping going to help inflation? Both of you said that. Maud, you're absolutely my favorite tonight. Because as I said here before, the Fed's mandate is to screw everything up. I thought their Fed mandate was 2 things. Where's the Fed mandate? Someone give me the Fed mandate. Employment, which is ironic that they want people out of employment, right? They want people to lose their jobs, not maintain the employment. And what's the other one? I saw employment in there. What's the other one? Inflation, right? Now, I don't know if it's inflation or just the interest rate to protect the dollar, right? So someone tell me, how does not raising interest rates help us with inflation? Or how does not raising interest rates help us with employment? So 2 interesting questions here. I don't know that stopping will stop inflation. It won't. Actually, it'll speed it up. In real life, it'll speed inflation up even more. But we'll let the rapid rise of rates get settled. The rapid rise of rates, in all honesty, was last March, May, June, and August. Went up 300 basis points. We haven't had a huge rate hike since like August, right? It was September last year. I can't remember when the 4 were. But how is 1 month going to help when those rates have already been raised 6, 7, 8 months ago? Second thought that I thought was really interesting. Stopping will protect the banks so there's not a higher run up on inflation. William, with all due respect, that's not economics. In fact, if I can go ahead and throw this out here, and I mean zero disrespect to you, that is politician or AOC economics. Not raising rates speeds up inflation, which has nothing to do with banking actually per se. It will help less banks. Well, it won't. It's just postponing the inevitable. If they didn't roll those positions when the yield curve inverted, or when the first 75 basis point or the second 75 basis point rate hike occurred, they're already screwed. There's nothing that can be done when on paper they're only worth 12 cents on the dollar. So not raising interest rates has zero help for the banks because of what's happened previously. Will it hurt future lending and lower that down a little bit more? Yes. But the guys that failed to take action, that got their big bonuses and didn't pay attention, are screwing the regional banks. And that's the problem. Both, Mod. So are these guys asleep or just dumb or both? They probably got paid. You get paid 7% in bond funds. I'm sure the banks are getting paid to broker this money, to buy these treasuries so the U.S. is solvent. Are all regional banks that dumb? No. There's some that did really well. There's an Alta Bank, which I found out was Belive or something, Belite Banks, which 28 billion, that's nowhere near this trouble. But 10% of their stuff is. So why is Schwab and BAC going down? So the good question. And so let me go ahead and I'm going to put that in the question section. You guys are going to have to go back and read a lot of this. Questions. So why is Schwab and BAC going down versus JP Morgan and Goldman Sachs not? So let me see if I can get us a chart that is ridiculously hard to read and understand, but I will do the best I can to, yeah. So give me a second. Again, I've done so much research on this all weekend long. It has been the pits. It's absolutely been the worst. Oh no, don't look at my password. Just kidding. Sorry, that's not that funny. So, see if my chart can. Come on. No, I'm pulling on a lot of internet. Just want my email. Come on, buddy. Wow, I might have some serious kids on. Oh, no, I'm just impatient, so it causes a serious backup. And I've got kids on stupid video games. Copy image. It all depends how you rate your book of business. Loans plus securities, a percentage of your deposits. Total deposit share that goes into this. The short answer comes down to this. JP Morgan, very, very safe. They don't overloan. They've learned from 2008. They've learned from 2010. They don't put themselves in that same situation where they have a good amount of their base protected and not loaned out. Whereas the higher risk part on their second or third dollar, Bank of America looks like at that 100 line. I think you said Credit Suisse. I don't see that in here. Goldman Sachs. Goldman Sachs is even different. They're even lower because they do more traditional banking. And Schwab is up here in the higher risk, but they don't have, Schwab is a little different. They do banking, but they also do the investment side, which is probably why Goldman Sachs isn't in here either. But Schwab is taking other risks with that money on the second or third time that it's being used or spent. And so the short answer is the revenue streams or their book is structured differently where they are not, although look at all the banks. I mean, this chart is confusing as it is already, but let's put it this way. JP Morgan, Goldman Sachs are not using the same dollar with the same risk as the others. Schwab and Bank of America, they're probably doing it 2 times. When you come down here, Zions Bank, using that same dollar on 3 liabilities. Citicorp, SIVB, it's just ridiculous. When we looked at Wells Fargo, right? Wells Fargo has a higher risk, but they're non-secured. Their rate for mortgages on non-secured was not here. It was way the heck out here, right? Their non-secured was way out on the 150. Non-secured loans, the bank only backs a certain percentage. Well, what about PMI? People were coming in with 20% after 2008. Wells Fargo found a little knack that they came in with 20%, they were waiving income. Same problem. Just because someone pays 20% of their house down, doesn't have PMI, doesn't mean they can afford the freaking house. Well, we'll just cheat a little bit and we'll cheat a little bit and we'll give bonuses for more loans that are approved from people that can't afford the house because we want the commissions and fees. Screwed Wells Fargo, just in a little different way. Again, money laundering, using the same dollar for 2 or 3 liabilities. We can't do it, but banks do it all the freaking time. Great question. We are way over my time. Are there any other questions you guys have that I can answer for you? I've got a lot of articles here that I will rush Dave to post today so that you guys can read what's going on. I'll make some other comments. But are there any other questions you guys have that I can give you an update today on before we wait till Thursday? Good job tonight, Kevin. That was the best explanation I have heard of this whole story, the usual mess in U.S. banking. Thank you, Maude. I appreciate it. William. Oh, you're ticking me off. William. So, Kevin, you haven't liked bonds, but why haven't you described it to us this way? And so the short answer is, William, I didn't have the explanation to do that. But what I did have, William, was the opportunity to tell you that your bonds this month were making a hell of a lot more than the previous month, and over and over and over again. An inverted yield curve. I probably didn't do a good enough job explaining that the short-term bonds are so much more attractive for a better return in a much shorter period of time than these longer ones. And in being so much more attractive, the liquidity for people buying and trading longer-term bonds dries up. Longer-term notes dries up. Longer-term bills dries up. And on paper, the paper loss on them is horrific. You'll get your $1,000 back, but if you need the money tomorrow for a health problem, a kid has an accident problem, it's like selling your stock low, not giving it the time to come back. You're selling your bonds low, not giving it the time to earn you the par value back. So, William, that's the difference between the two. And yes, David W. Notice this is what we do at Hurley Investments. If I can't show you the potential opportunity through these numbers, I'm not going to be a good fit for you. Some of you have gone through this through a cycle or two with me, and you're like, you know what? I wouldn't put my money anywhere else. But David, notice this cycle has made up timing. You can't time the market. And if I look at this group, Bosserman, definitely. Dave, definitely. William, definitely. You probably came in more at a top and we're still in that downside before we find the trough. So for you three particularly, you're probably looking at your portfolios and going, you know, Kevin, to a certain degree, I think you suck at protecting. But I'm sure I can show you how high Meta was and Ford and all these stocks that have lost 60, 70, 76 or 83% of their value. And I guarantee you, you're not down 60, 70, 73, 76, 83% in your portfolio. That's because we're in the process of picking up those shares. And all I can tell you three out of this group, and I'm doing it kind of tongue in cheek because I'm not looking at your individual portfolios when you came in. What I'm telling you is just in Meta this year, it really jumped portfolios. And we have this opportunity sitting in the wings. Well, Kevin, tell us what stocks have that opportunity sitting in the wings on. We do not have that opportunity with Apple. We do have that opportunity with Boeing, Bank of America, Baidu. Disney lost half its value plus, definitely. Ford lost 3/4 of its value. Google, no. JP Morgan is borderline. It's lost almost half its value where it's at today, but it lost more than half its value in its past, and it's going back up. No for Coke, no for Lockheed Martin. Meta, we have that opportunity, and we had a great run on it this year so far, and the last year. Micron, we have almost have that opportunity of losing half of its value. Square, we have that opportunity losing 80% of its value. Under Armour losing 3/4 of its value, we have that opportunity. We do not have that opportunity in Visa. So as I go through core holdings, that's where you have your opportunities, being 100% honest with you. One more time, you do not have this type of opportunity in Apple, but you do have a lessened version of it. You do have this opportunity in Boeing, Bank of America, Baidu, Disney, Ford. You do not have it in Google. You borderline for JP Morgan. You do have it, just not the big explosive doubling your position. You do not have it in Coke. You do not have it in Lockheed Martin. You do have it in Meta. You do have it on Micron, but that's also borderline super close. You do have it in Square. You do have it in Under Armour. You do not have it in Visa. And so those are, that's where we're at in that position. So Dave, I hope that answers it for you. Any other questions? You got to be tired of hearing me. It's almost been an hour and 23 minutes. But please, if you have any other questions, again, Dave, I'm so glad you asked that question there instead of just letting it ride. That was an excellent question that I think will mean a lot to, William, William, if you have a question from you, I forgot who the question came from. William, Dave, and Bosserman. Hopefully that was helpful for you three, particularly. All right, then. Hey, no other questions. I appreciate your time. Stuart, I need to give you a quick call immediately after. Guys, have a good evening. If another question comes in, I'll answer it. I think this was a big one. Thank you for being here tonight. Guys, take care. Have a good evening. CPI numbers tomorrow and Wednesday, which scare me. We're probably going to add puts back in to follow the market down. And guys, have a good evening. Look forward to seeing you Thursday morning or next Monday. Good night.